My name is Jake, welcome to the channel. In today's video, we're going to do another Review My Pie video where I review subscriber portfolios. These last couple of days have been pretty crazy here in the stock market. And when you see a pullback in the market or a shock to the market by 3, 4, 5%, it catches everyone's attention because we're so used to seeing our portfolios only go up. If you've been investing since April of 2020, you only know up and to the right. And I was listening to these commentators on CNBC over the last couple of days where, when you saw the market drop, like the Dow dropped 1,000 points, everyone out there was saying, don't buy the dip, don't be quick to buy the dip. And it just reminds me once again that no one really knows what direction the market is going to go in. No one really knows where we're going to be at 3 months from now, a month from now. If you're trading the market on a short-term basis, it can be very stressful. If you're a long-term investor and your investing time horizon is in the decades, then I think you can invest today regardless of what is going on. You can rest assured that you're probably going to be okay if you're investing for the long term. It is really difficult to find value in the stock market today. With the stock market at near all-time highs, there's pockets of the economy that are struggling, and I think there's really some great values to be had in the market today. Before we dive into the video today, I want to share with you a company that I believe is undervalued and that may be of interest to a lot of you investors out there that are maybe seeking yield but don't really want to take on a lot of risk. In my real estate portfolio, I hold 12 different companies and including one ETF. There's one company in here that is, in my opinion, extremely oversold or is in value territory, and that is Omega Healthcare. Omega Healthcare has been beaten up pretty bad over the last couple of months. A lot of this has to do with the surge in the pandemic that we've seen here. As you know, Omega Healthcare is really focused on skilled nursing. So obviously, I think it's a logical reaction that people can think, okay, well, this is maybe a higher risk investment. But if you peel back the layers and you look at their quarterly reviews, you can see the pandemic has impacted their business, but not nearly to the extent of what is reflected in their share price. If you look at the data here on M1 Finance, you can see that it has a current starting yield of just over 8%, but this is actually not correct. There's a lot of different websites out there that will have misinformation around the starting dividend yield, the payout ratio, et cetera, but I want to take just a second and share why I think this is a great opportunity to take advantage of the dip on a company like Omega Healthcare. M1 Finance shows Omega Healthcare with a starting yield of 8.29. If we go over to Seeking Alpha, you can see that it has a starting yield of just over 8.5%, 8.68. It can be a little bit frustrating if you're a do-it-yourself investor and you're gathering information. You want to kind of double check everything that you're seeing on different websites because you will see different information on Yahoo Finance, on Google Finance, on Seeking Alpha, etc. So if we pull back the layers and we really look and see, okay, what are we getting if we invested into Omega Healthcare at $30.86? We can see that they currently have an annual payout forward of $268. Okay, $268. So let's take a look at that. The dividend history, it has it at $268. This is based off of a quarterly dividend per share of 67 cents. It's expected, or at least anticipated, that Omega Healthcare will increase their dividend here in the next month, here in October. A lot of passive investors that don't really follow the companies that are investing in, they may overlook this. But actually here in the next month, it's expected or anticipated that Omega Healthcare will raise their dividend very slightly to 68 cents per share. Now, it is important to mention that this is expected, not declared. So once it's declared, we'll know for sure. So right now it's kind of speculating because we really don't know. But looking at their last earnings report here in the last quarterly review, they are expected to raise their dividend to 68 cents per quarter. So if they were to raise their dividend 68 cents per quarter, they would have a forward annual dividend per share of $272. Okay, so you got $272, and if we take the current share price of $386, let's say, for example, we invested $10,000 at $30.86, whoops, it's going to give us 324 shares. If we times that by the $272 forward dividend, it's going to give you just under 9% starting yield, so 8.81. This is one of the cool things about investing in individual companies is you can find those hidden gems out there in the market that are maybe overlooked, that are not really overvalued. And as a dividend investor, you can take advantage of those. That is one of the big advantages of investing into individual companies, because you can find these hidden gems in the market. So if you were to invest into Omega Healthcare at today's prices, you would have a forward starting yield of just under 9%. This is massive. There is a lot of value to be found in the market. You just have to know where to look. If you want to learn more about Omega Healthcare, you can head over to the channel. I made an entire video where I analyze Omega Healthcare. It's called The Future Dividend Aristocrat with 7.5% dividend yield. Now here's the cool thing. It's no longer with a 7.5% dividend yield, but at these prices, it's at nearly a 9% starting forward dividend yield. Absolutely amazing. And on top of that, if that's not enough, this company is projected or is on a path to become a future dividend aristocrat. Now, obviously, I can't predict the future. I don't have a crystal ball. These are obviously just my opinion. But if you're a long-term investor, this is definitely a company that you may want to check out if you're looking for a higher starting yield today. In today's Review My Pie, we're going to review 4 portfolios. The first is from a 25-year-old here in the US. The second, a 34-year-old here in the United States. The third, a 23-year-old from the Netherlands. And then the fourth, I don't know the age, but this individual is here in the US. The timestamps are in the description below, and as well, the portfolio links are in the description below. And as always, everybody, I'm just a random dude. Don't take what I'm saying as financial advice. It's just merely for your entertainment. I am so grateful that I'm able to make these videos on a weekly basis and that I get to interact with so many great people out there. Thank you so much for every one of you that have been following and supporting the channel. I appreciate every single one of you.
You're special to me. You are the only one like you. Like you, my friend. I like you.
All right, now that we got some special vibes from Mr. Rogers, let's take a look at the first portfolio from Dennis. He writes, "Hi Jake, I'm just saying I'm a big fan of dividend investing and I love your channel." Thank you so much, Dennis. I appreciate the kind words. Some background, I'm 25, living in California, and started investing last year. I have a Roth IRA with TD Ameritrade where I invest $500 a month into the S&P 500 index. Really good idea. I also have an M1 account where I invest $100 a week. Once I received my first dividend, I fell in love with the idea of not selling your shares and living off the dividend. I'm open to risk and I have a large time frame in mind, about 30 years. I'd like to get your advice on my M1 portfolio. So this is really great. I like that you're investing into a Roth IRA. You're already diversifying across retirement accounts. You have a Roth IRA, you have an individual taxable account. I think you're off to a really great start. So with a time frame of 30 years, let's take a look at your portfolio. I can't see why the graph is not working, so I apologize for that. I don't really know what's going on there. You got 26 holdings. You have over a 2.5% dividend yield. The expense ratio, this would be important to see the graph here to see if you're beating the S&P 500, because when I'm looking if you're beating the S&P 500, I'm looking at your historical performance and I'm looking at your starting yield. Because that usually is the benchmark you want to compare against the S&P 500 in terms of a total return. So let's take a look at your first slice. You got dividend stocks at 70 and ETFs at 30. In your dividend stocks, you have them fairly equally weighted for the most part. Your largest holding is Walgreens. So my question for you is, why Walgreens? Do you work at Walgreens? Does a family member of yours work at Walgreens? Why are Walgreens, JP Morgan and Johnson & Johnson, 3M, why are these your largest holdings? Are these your do you have the highest conviction in these companies? And if you don't know the why, then maybe, asking yourself or reevaluating your strategy may be a good thing to do. But as it stands, these are great, really well-established blue chip companies. So looking at your other holdings here, you got Apple, you got Verizon. Verizon and Apple are very different, right? Verizon is like an equity bond almost. Like it's actually fairly valued at the moment right now. You're getting over a 4.5% dividend yield. It doesn't grow very fast, but it's a very steady, consistent dividend player. Apple, really for growth. You got some really good dividend companies in here. You got your Pepsi's, McDonald's. McDonald's just raised its dividend by 7%, right? Microsoft not too long ago raised its dividend, I believe 10% if I'm not mistaken. You have a growth component in here with Disney, Home Depot. You have Chevron. So Chevron for the next 30 years. So you want to hold these for the next 30 years. What is your bull case on Chevron? What is Chevron going to be doing in 30 years? I think that's one question mark that you might want to take a look at. AbbVie, really great. Waste Management, Procter & Gamble. These are all really, really great companies. I guess you got Tesla as a hedge against Chevron. I don't know. So I think the important thing with these here is really understanding why you're investing in them and understanding how they make money. And with 23 holdings, I think that is very manageable. Let's take a look at your dividend ETFs at 30%. You got SCHD, love it, VNQ, and DGRO. These are three really, really great ETFs. I just made an entire video on SCHD not too long ago. Really great ETF. VNQ is one of my favorite, REIT ETFs, and DGRO is really, really good. One thing that I would mention is $100 a week. You have to understand at your age of 25, your goals and priorities are going to change over the next 20, 30 years, even the next year, right? So I think a key thing when you're 25 years old and you're building out this portfolio, I would make sure that you don't think that you have all the answers today, because life is going to throw you so many curveballs that you want to make sure that you're remaining flexible. And that's why I like that you're first maxing out your Roth IRA. Thank you so much for sending over your portfolio. All right, let's take a look at the next one here from Tim. Tim writes, "Hey Jake, been a fan of your channel for a while now and wanted to reach out for the first time with a Review My Pie request. Since I have many types of taxable and retirement accounts on my path to FIRE, financial independence, retire early." So you got a Roth IRA, rollover IRA, HSA, high dividend, long-term growth, income emergency fund, etc. I love this. I've compiled all of my holdings, cost basis, and dividend yield on cost in one Google Sheets document. It has a lot to look over, so feel free to review the major holdings and such. I appreciate any and all help. I never had anyone look into my portfolio in its entirety before. I look forward to your comments. A little bit about me: investment portfolio of just under 200K. Age 34, married, hospital worker, counselor, homeowner for the last 3 to 4 years, currently house hacking. This is huge. You're house hacking. Really, really great idea. 65 to 60K annual salary. I'm assuming this is just yours. Does your wife work? What's going on there? 50% savings rate most months. This is huge. Dividend value investor, goal is to live off dividend income someday. Want to coast FIRE at age 40 if possible. Okay, so this is cool. Tim, you're definitely going to want to check out the dividend reinvestment compound calculator that I've shown here on the channel before. You can find it in most links in most of my videos, but there you can play around with the dividend reinvestment calculator. I think that's going to really, really be helpful. One huge distinction that you really have to make sure that you're aware of is factoring in, understanding living off of your dividends is very different than the traditional FIRE movement, right? You're investing, just in the total stock market versus investing into individual companies and et cetera. There's a lot of differences, but there's also a lot of similarities. Another thing that you didn't really mention here that I think is important is health insurance. How you plan on covering health insurance is also going to be really, really important, because it sounds like, I'm looking at your email here, and it sounds like you've thought of everything. So I just want to throw that out there, that make sure that you also understand or have a plan of attack when it comes to health insurance. All right, so let's take a look at your portfolio. There is a lot to unpack here. So you have a lot of different accounts in here. You have a taxable account, retirement account. This is really, I think, by looking at this, you almost remind me as an engineer, right? You just are thinking every single piece of this through, which I think is so, so cool. So here in the middle, you have your net worth broken down by account type, your home. I think this is really great. So you have all of your accounts into here. You have your investment portfolio broken down by account. I'm assuming, this is by account. So you have multiple accounts. So you're not only diversifying into individual companies and investments, but also in different investment accounts. I like this. Okay, so your largest holding is Tesla. Rock on, man. That is awesome. So your largest holding, you've done very, very well for yourself if Tesla's your largest holding. You got Alibaba. Well, I guess you haven't done so well with Alibaba. Alibaba has been taking a pretty big hit. You got Lockheed Martin. You got Corsair Gaming. Okay, cool. Corsair, if you have a different brokerage like Robinhood or TD Ameritrade or whatever, I think Corsair is a great growth stock to run cover calls on or cash secured puts. That's not something that I really do, but I think that would be a great company to do something like that in one of your other brokerages, because in M1 Finance, you can't do that. You got your Palantirs. So yeah, a lot of these growth stocks, you could actually generate additional income through cover calls and cash secured puts. So that's something that if you're not already doing that, that's something that you definitely, I think would make a lot of sense to look into to generate income, right? You're selling the puts and you're selling the calls. You're not buying them. Very important difference there. You got your Altria Groups of the world. You got your NextEra Energies, your Microsofts, Nvidias. So yeah, in a portfolio like this, if you never plan on selling your shares, I think holding growth stocks like this, I think it may even make a lot of sense holding these in another brokerage besides M1 so that you can sell cover calls on them if you wanted to. You could generate a lot of other income by doing so. It is a lot of work, but you could look at generating additional income that way. I would say the majority of people following my channel, that's probably not something that a lot of you want to do. I'm looking at this guy. This guy is engineering everything. I think selling cover calls would be just right up your alley. Okay, so you got a lot of stuff there. You got your different accounts. It looks like you have index funds. Yeah, I mean, you got the S&P 500. In my opinion, I think with these retirement accounts, me personally, I think this is maybe going a little bit too far. For me personally, I would pick 3-4 really high quality index funds and just keep those. That's just my personal opinion. I just, this obviously is a hobby of yours, and everyone has their different style. For me personally, I think this is a little bit more than would be necessary, but it is kind of cool to see how you've broken it down. So Tim, when I look at everything that you're sharing here, I think you're putting a lot of thought into everything that you're doing. And I think you're probably already doing this, but my only concern, I guess, with this approach is you're really going to have to get into the nitty gritty, which I think you would appreciate, or you probably wouldn't, shy away from, is the tax optimization of this strategy. But I think you're off to a really, really great start. You've talked about house hacking. You've talked about making more money. I think you are really, really in a great spot. And I think a lot of people following the channel and watching this are going to feel overwhelmed. So the majority of people would not benefit from this approach, I don't believe, but someone like yourself who really wants to get into the nitty gritty, I think this is absolutely great. Thank you so much for sending over your portfolio. The next portfolio is from Tom. Tom writes, "Hi Jake, I'm Tom from the Netherlands, and I just started investing some months ago. Your videos gave me some useful tips to start out, but of course having you respond to my portfolio would be even more helpful. I'm trying to keep my portfolio balanced around an 80-20 split between value and dividend and growth and risk, respectively. Since I'm still young, I figured it might be better to focus more on growth. I deposit monthly to invest in the dividend stocks and buy risk growth stocks when I feel it's a good time. These are 36 holdings, and I'm wondering if it would be better to lower that number." I forgot to add the picture. I guess you know why. GME, so GameStop. All right, cool. Well, first off, Tom, thank you so much for sending over your portfolio. I got to visit the Netherlands quite a few times. I love the Netherlands. It's such a great place. So when it comes to your 80-20 split, I think when you're younger, you really should focus more on growth. And I think we need to make sure that there's a distinction between what I'm talking about as growth and what you may be talking about. When I talk about growth, I'm not talking about GameStop or stuff like that. I'm talking more about like Microsoft or Apple. So it's important to make a distinction between what I define growth and maybe what you may define it. So if you're asking the question, is 36 too many? I think you know the answer. If you ask the question, you probably are in that situation where you probably would benefit from trimming down your holdings just a little bit so you could get more focused. That's just my opinion. If you ever feel like you're not getting enough exposure to the market, you could always add in an ETF, and that will help kind of get more broad exposure to the overall stock market. And the cool thing is you can get thematic ETFs like the ARK ETFs, or you could go with technology ETFs. My favorite is from Vanguard, VGT, or you could always just go with the S&P 500 or the total stock market if you wanted to. So let's take a look at your portfolio. Your largest holding is GameStop. I think you're probably feeling pretty good or pretty bad depending on when you bought it. Hey, if you want to have fun with a part of your portfolio, as long as 80% is your core holdings or your core strategy, and you want to play with a small portion of that, I think that's completely fine. That's what we call the core and satellite methodology or approach to investing. That's something that I personally follow myself. You got Realty Income. This is a really good retail REIT as well. You got AT&T. Not the biggest fan of AT&T, but I think you sent this portfolio in actually before they announced the split with Warner Media. Dominion Energy, that's fine. I like NextEra Energy and Duke a little bit better than Dominion. Southern, I really like. I'm not familiar with Czech. Verizon, ExxonMobil, Enbridge, Pfizer. Some of these I'm not familiar with. Pepsi, IBM. Okay, IBM. That's interesting. Why IBM? You're in your 20s. I think IBM is a lost opportunity. I think I work in tech, and IBM is really not where I would put my money if I had a long investing time horizon. I would look at like the Apples of the world, the Microsofts of the world, not necessarily IBM. Walmart, like it really depends on your time horizon with IBM, in my opinion. Walmart is great. Another one that's great is Target, JP Morgan, Gilead, Coca-Cola, McDonald's, Digital Realty Trust. So you got growth in here. Here's your Apple. You got growth, you got value, you got a little bit of everything in here. You got 3M and you got Leggett & Platt. I really would recommend understanding what your core goals are. What is your main goal? And if you don't know what that goal is, if you don't know when you're looking to live off of the dividend or what your purpose is or why you're investing, I would recommend starting there. It's always easier if you work backwards. First, you define, okay, what is your why? Why are you investing? What is your goal? Then once you have your why, then you can build your portfolio so that it gets you to your destination. I talk a lot about the investments that you invest in. That's the vehicle, right? The destination is where you want to go. And depending on where you want to go, that's going to determine the vehicle that you're going to drive. If you want to go off-road into the mountains, yeah, you want a Jeep Wrangler. If you want to go down Las Vegas Boulevard, or if you want to go into LA, then maybe you want a Lamborghini, you want a Ferrari, you want something more flashy. It really depends on your why and your destination, and then you build your portfolio backwards. I hope that is helpful. Thank you so much for sending over your portfolio. All right, the last portfolio is from Brent. He writes, Jake, thanks for your channel. I've enjoyed learning about dividends. My wife and I have 3 kids under 5 and would like to add more. We are both currently working, but she would like to be a stay-at-home mom. The goal of the portfolio would be to produce enough immediate income for her to stop working in about 5 years, while at the same time providing at least some growth potential that we would enjoy for retirement in 30 years. I chose some higher yielding stocks ETFs to help reach our immediate goal quicker. And I put some more growth-oriented stocks ETFs in the pie for the long-term retirement goal. How did I do? Well, Brent, I think this is really great. You have really detailed goals. You have timeframes listed out. I think this is a really great position to be in. Just a minute ago in the last portfolio, I said, know your why, know your goal. And this is a situation where you know your destination. Your destination is in 5 years, you want your wife to stay at home and you want to continue growing your family. And the goal here is to get immediate income to supplement so that your wife can stay at home and you don't have to sacrifice your standard of living for your family. This is really great. So immediate, we're going to define immediate as in 5 years, the next 5 years. But let's take a look and see from your portfolio and see where you're at. Unfortunately, we can't see the graph here. Hopefully, when we go into the individual slices, we'll be able to see that. So you have a starting yield of just under 4%. You have a low expense ratio and you have a lot of holdings. Okay, so my first initial thought would be, Why do you have so many holdings? In my opinion, it may make sense to reevaluate your strategy around how many holdings you have in your portfolio. Let me give you an example. One thing that you may want to consider, that something that we don't like to think about in life, but it is just natural, is if something were to ever happen to you and you were to pass away, would your wife be able to take over your portfolio and manage your portfolio? So it's not something that's really, a fun thing to think about, but it is really an important thing that as a family man, you or maybe, if your wife were to be a stay-at-home mom, you're the sole provider, right? And if something were to ever happen to you, making it easy for your wife to be able to manage your investments. So it's something to think about. It's not really a happy thought, but it is reality. Maybe thinking it from that perspective, would your wife be able to manage your portfolio if something were to ever happen to you? If your family is going to rely on this source of income as their primary source of income, if, heaven forbid, something were to happen to you. So let's take a look at your slices. You have 3 slices here. You have dividend ETFs, you have REITs, and you have dividend stocks, and they're fairly equally weighted. Okay, so let's take a look at your dividend ETFs. Your goal here, if I remember correctly, you wanted that immediate income, but you also want that growth component in the background where it's still growing. Okay, so you have 9 ETFs in here, fairly equally weighted. You have VYM, SCHD. Okay, so right off the bat, what I'm gonna say is, I would recommend picking 3 or 4 of your favorite. I think 9 different ETFs is a little bit excessive. That's just obviously my opinion, but in my opinion, I would pick maybe 3 or 4, maybe 5 at the most of your favorite. And I'll share with you my favorites and why. My favorite, I really like VYM and SCHD. I like these because they are very different and they're focused on a higher starting yield, but they're really, really high quality, low fee ETFs. I like SPYD, but you have to be aware of the exposure to real estate because you're going to get taxed higher with SPYD than you would with SCHD and VYM. I'm not a big fan of VIG. I don't really like VIG and I don't like Noble. The dividend is too low and it doesn't grow any faster really than the S&P 500. In my opinion, VIG and Noble, they're not my favorites. I don't recommend investing into those, just overall generally. SPHD is an okay monthly dividend ETF. It has a higher expense ratio. I just don't see, the performance in it. I personally would rather invest heavier in JEPI if it were me and not have SPHD. But that's just my personal opinion. HDV is good if you want to get more exposure to oil, for example, without taking on the immediate risk. HDV has a lot of exposure to ExxonMobil and Chevron. This is one that I've looked at in the past. But for me personally, I would pick 3 or 4, maybe 5 of your favorites. My favorites, VYM, SCHD. I really like JEPI, so I like those 1, 2, and 3. I really like DGRO as well for the growth. You're getting a higher starting yield with DGRO than VIG and Noble. And it's growing. It's even growing faster. And it's just, those are my favorites. And so that's how I personally would set it up. And if you did want a little bit of real estate, I think SPYD is good. You could also look at VNQ, but once again, that's real estate, and you're going to be paying higher taxes, assuming this is in a taxable account. But it looks like you also have an entire slice on REITs, so maybe having a little bit in VNQ or SPYD won't be the end of the world. So let's take a look at your REITs here. You got WPC, really great REIT. This is one of my top 10 REITs. Realty Income. This is by far one of the best real estate REITs. The key thing with Realty Income is when you buy. Your entry point is really the biggest thing when it comes to investing into Realty Income. This is a pretty cyclical REIT, so it goes up and down with the market. You really want to be careful of when you buy Realty Income. The exact same thing with Stag. Stag is one of the best monthly dividend REITs out there, but you have to be careful of when you buy it. MPW, really great. Omega Healthcare, wonderful. We talked about that Omega Healthcare in the beginning of the video. Really good. You got Iron Mountain. That's fine. You got Land, DLR, Crown Castle, LTC. Yeah, LTC is okay. Not my favorite, but it's not bad. Cube, American Campus Communities, Store, Okay, so there's a lot of great REITs in here, and you're very well diversified. You got your data centers, you got your retail, you got your industrials, you got your cell towers, right? This is a really, really good slice. I like this slice a lot. In my opinion, what you could consider doing is you could try to get this slice up to 5.5%. You could increase your exposure to Omega Healthcare, MPW. I like WPC. And then you could lower your exposure to these others. And that way, if you could get this up to 5.5%, I think that's going to be, you're going to be in a much better position. You look at this, 130% performance with a 4.5% dividend yield. This is crushing the S&P 500. This is a really, really good REIT slice. I really like this. Dividend stocks, this is where you got the majority of your holdings. Holy cow. Okay, so you're equally weighting the sectors. What I would, and you even have a 4% dividend yield. This is actually really not bad. Wow. Okay, so you got your utilities, Southern Duke. Okay, you got these equally weighted. Technology, Broadcom, so you're focused more on the higher yield with Texas Instruments as well, but you still got the growth component with Microsoft and Apple. I'm flying through these here pretty fast, I know. So you got Dow, Nucor, Sherwin-Williams. Yeah, I mean, you're doing this actually pretty well, given your goal. AbbVie, Johnson & Johnson, yeah, these are good. Financials, oh, there's a lot of financials in here. Okay, you got your, well, Glad's in here. I'm not quite sure why Glad's in here. But yeah, your Franklin Resources, JP Morgan in here as well. Okay. Yeah, that's fine. I'm saying that this is not how I personally would do it, but I can understand why you would do it. Energy, ExxonMobil, Enbridge, Chevron, Phillips 66, and BP. These are good energy companies at 10%. Yeah, in the short term, the next 5 years, I think you're set up for success. 30 years, maybe not so much, but the next 5, I think you're fine. Consumer defensive, you got Altria Group, PepsiCo, Coca-Cola, Walgreens, Kraft. Okay, so you already have a sin stock in here. Another one that you could take a look at is British American Tobacco. British American Tobacco is yielding right around 8%. So one that you could check out, it's one of my largest holdings in my portfolio. It's a really, really great income oriented company if you're looking for current income or if you're looking for yield. Consumer cyclicals, yeah, these are fine. Not the biggest fan of H&R Block, but that's just my personal opinion. I like Target as well. You could take a look at Target. Communications, Verizon, AT&T, Comcast, and you have these at the higher. Yeah, this is really fine. I am so impressed that you have a 4% dividend yield on average here. Even with the market up so high, this is actually really, really, really good in my opinion, and you have decent growth. Well, Brent, thank you so much for sending over your portfolio. Some overall thoughts from my side. I think you could reasonably cut the holdings in your portfolio in half. And I think you could still accomplish what you're trying to do by generating a higher starting yield for immediate cash flow, as well as still having that growth component in the background working in your favor. I think you could cut your dividend ETFs in half to maybe 3, 4, or 5, and really focusing on the highest quality ETFs in there. And I think your REITs, I really like your REIT slice. I think you could also cut some of your REITs in there, but also even try to get that REIT slice up to 5.5%. I think would really be a reasonable thing that you could shoot for. Your dividend stocks, I think having all of these slices are fine. I think me personally, I would have maybe 2 or 3 individual companies in each individual slice, and I think it would make your life a heck of a lot easier. So that's just merely my opinion, but as it stands, I think you put a lot of thought into what you're doing. And then what it comes down to are those 3 things: cutting your expenses, staying out of consumer debt, and looking for new ways to make more money. Thank you so much for sending over your portfolio. Thank you so much for watching, everybody. I hope that you got value out of the video. I hope that there was something that you picked up that you could take action on and really, implement into your portfolio that will help you in your investing journey. Thank you so much for watching, and I'll catch everybody in the next video.
You are my friend. You are special. You are my friend.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.